Go ahead and start. All right, everybody. Good evening. Happy Monday. I'm Sam from San Jose, California, and today is my honor and pleasure to be tonight's host for the training today. Rebecca asked me to talk about something, on the technical side, which I will do. And today's topic is retirement basics. Now, do not let this title fool you. Because it's basic, but there's a lot of material I'm going to cover. Okay, so without further ado, let's get started. And then I am going to put everybody to chat only with me, so we don't have too many interruptions for people who are arriving late. Okay, let's get started. All right, real quick, for those who do not know me, I am Sam. I'm SMD in San Jose, California, and I've been doing this for about 14 years now. And those are the states that I am licensed, either have an office or I have clients or business partners. My major is electrical engineer. I work in corporate, like many of us, climbed the corporate ladder. And I worked there for probably good 15 years, almost 15 years. And I got tired of that. So I decided to have my own business. And WFG was not my first business. I was a business owner for a media company, dealing with communications. So I started that in 2004. And concurrently in 2009, I came to know WFG. Okay, and at that time, really, I just started to. I left a good job. Really, I had a good job at the corporate because I really just was at the top. I was the VP of a company. And I really just wanted to explore something different, is there something different that I can do? And also wanted to better take care of our money, obviously. A downturn, the market downturn impacted us. I wanted to have a better control of my time, even though that I had a good job, but the company controlled my time, and I wanted to see how can I control my own time and spend more time with my family, or at least have a more balanced life. And like most of us, we want to have financial freedom, and I was no different. As I got to discover, I think financial freedom is important, but also time freedom. I see a lot of people who make a very, very nice paycheck or make salary or whatnot, but they're too busy, right? It could be a corporate person. It could be somebody who runs a restaurant. They make great money, but they don't have time with their family, and that's what the situation I was in, and I wanted to change that. So that's my little brief introduction. Okay. So today we are going to cover areas I'm going to cover. The first section, I am going to talk about these 5 different type of risks. Okay, and I call them the blind spots. Okay, because most of us we may heard of any of this, but we do not know, number one, how to take care of them, and number two, how does it impact us? So today I want to talk about market risk, withdrawal rate risk, longevity risk, inflation risk, and tax risk. These are not everything, but if you get a good handle of these 5 items, you will be in a pretty good shape, I would say. Okay. The next section I'm going to talk with all the common retirement plans. Okay, and I'll go through a quick overview. There's a lot of information in this part, so don't be overwhelmed. The slides will be sent to the SMDs, and feel free to review with them. I will provide some strategies. How do we put it all together? And then last but not least, how do we optimize once we put it all together, how do we optimize by doing it in a combination? Okay, so that's my agenda. So let's take a look at this. There are 2 photos of here, and I want to ask everybody, who do you think? I mean, who do you think has retired? On the left-hand side is a older gentleman. He works at Walmart, and I do not know if he works there because he wants to kill time, or he wants to make money, or he wants to do both, maybe both. I don't know. And what about the nice-looking young lady over here on the right-hand side? Very chic, and probably has a great life, and she's young, and she's probably traveling the world. So, I want to say that, do you think that retirement is age related? or oftentimes is financial means related, right? In other words, if we are financial free, we can still work, but doing the things that are important that we want to do rather than we have to do, right? And by the same token, if we are older, do we work because we want to or because we have to? And I find it, the more often than not is the latter. We work because we have to, not because we want to, right? And so it's really, retirement is not about an age, right? Anybody can retire at a young age, or anybody who is old may still have to work. Okay. Now, a quick statistic for everybody, and this is really shocking. Like 33% of Americans, 33, 1 in 3 Americans do not have any retirement savings. Can you believe that? It's really striking. It's really shocking, and if you were to look at 23, 10, 8, these people up to like almost 50% of people they have some savings but have less than $100,000, and that's considered average. And only few, maybe 5% of people have, about $300,000, and only 13% of people have $300,000 or more. So this is quite striking because, because if we live 20 years past retirement, no matter how you spend it, no matter how you do, no matter how big of a saver you are, the chances are, if we have $300,000, it's probably not going to be enough. Right, so this is something for us to be concerned, and also it's a great, in my opinion, it's a great thing on what we do, because we can help people get out of this percentage, get out of these statistics, or at least move to the right of these statistics, right? All right, so the first item on the list is that concern number 1. I have 5 concerns, right? So the first concern is the market risk, and this is the S&P 500 since 1996. Let me go ahead and put my annotator here so you guys can see my cursor a little bit better. Okay, so this is the S&P 500, yes, from 1996 to 2021, June of 2021, and as you can see, it's almost like a roller coaster. You agree? The first wave was in toward the end of the millennium, right? The IT bubble. The market went from peak to trough, lost 49% from late 1990, 99 to about early 2002, right? And then we had another drop, which was 2008, 2009, and that was for the mortgage crisis. In between 07 to the end to the beginning of 09, maybe. The market dropped 57%. And then from February 2020 to March 23rd, the market dropped 34%. That was COVID-19, right? And then the market went up on an upswing. Everybody's happy again, but it didn't last very long, right? Because if we were to look at the modern history, right? I just got this from Yahoo not too long ago. If you were to take a look at January 1st to December 31st last year, right? And you can pull this from the S&P, from Yahoo Finance. And again, I'm running based on the S&P 500, okay? So during this 12-month period, the S&P 500 dropped 20%, 19.44. So whether you have $100,000 or you have $1 million or whatever amount, that we may have for retirement, think about it. Yeah, lost 20%. That is not a lot of fun, right? That is not nothing to smile about. So this is the S&P 500. What about the NASDAQ? NASDAQ is comprised predominantly of high-tech companies, right? So again, from January to December last year, the NASDAQ actually dropped even more, 33%. Now, this is a little scary, isn't it? If you have $1 million, now you only have 670,000. That is not fun at all. And the reality is that market risk is the reality, and not you, not me, not any guru can control it. That's the reality. We can participate in it. We can have strategy with it, but we cannot avoid that reality that it exists. Okay. Now, the second concern, and obviously I want to talk about later, how do we address it? The second challenge that most people in retirement or for retirement, and I want to say that with cautiously, I don't mean people in retirement. I mean everybody. I don't care if you're 20 years old or you're 60 years old. All these concerns should be the same, not just for somebody who is old or about to retire. Okay, and this is for the second concern, called the withdrawal rate risk. So let's take a look. This is a study done by Fidelity, and it goes to say that we may have some money saved up, right? And then we are going to retire. Let's say, and this is the actual data, by the way. Say in 1972, if I have some money in 1972 and about to retire, and let's say that at that time, the assumption is that I am 65 years old, I am going to retire. Now, if I were to have $500,000 in my portfolio at that time, ready to retire with $500,000, how much money can I draw to have enough money to last as long as possible? Okay, and that's considering that I take some money and then the remaining I continue to stay invested. All right, so the first scenario is out of the 500,000, I am going to take 10% every year. Okay, the remaining of my money, 450,000, that would be, right? I'm going to keep it in the market, and I am going to invest between 50% in stocks, 40% in bonds, and 10% in cash. That is assuming I'm doing that. If I'm not doing that, then it's probably even worse, by the way. Okay, so let's assume that were the case. $500,000, take 10%, and the remaining get invested. Guess what? I will run out of money in 8 years, 1972 to 1980. In 8 years, with the market risks concerned, I will run out of money. Well, obviously, that tells me, well, I had to take a little bit less money, right? Well, what about 8%? If I were to draw out of that $500,000, 8% per year, the remaining continue to be invested, my money will last 10 years. Not a lot more encouraging, right? It will run out in 10 years. Well, what if I go 6% out of my $500,000? At 6%, I would run out of money in about, 16 years. 16 years, I ran out of money. At 5%, I will run out in about, 20, 24 years or something like that. So everybody, all the experts, all the financial advisors, all the industry leaders, they said the average rate or a safe rate is 4%. 4%. I want everybody to remember this 4% because we're going to use that later again. Okay, so remember this 4%. So if I have $500,000, I'm drawing 4%. That's how much? That's $20,000 per year. So that will ensure us, hopefully, that we will continue to invest and we will never run out of money. That's a good thing. The challenge is that $20,000 is not enough, right? So that is another concern. But here in this slide, we are talking about at 4%, that will probably play it safe for us not to run out of money, okay? The next concern will be, what if we live too long? Okay, having a long life is great with two caveats. Number one, we have to be healthy. And number two, we have to be financially equipped, right? So according to statistics, men over 65, the demographic of people who is 65 years old, the average man will live to age 86. 50% chance a male 65 or above in today will live to age 86. Ladies, you guys enjoy 3 years more at 89. And if it's husband and wife, one of us, husband and wife, will live to about 94. So obviously having a great life, a long life is good as long as we're healthy and we have money. Now, if you were to think about that previous example, $500,000, and it has to last me 30 years. If I'm retiring at 65 and I live to 94, my money has to last 30 years. That's a lot of years, which means that I need to have enough money. Okay. Now, the fourth concern is inflation. Everybody understands inflation, but a lot of people don't account for it. And to be quite honest with you, I think the silver lining in today's economic situation, the silver lining high inflation, is that it is a wake-up call for a lot of people that inflation is real. It's real. A gallon of milk, right? A dozen of eggs, our health insurance, our college tuition, it all goes up, right? It all goes up. So let's assume that if today I am 65 and I'm going to retire, if I have $50,000, my annual expectation, well, it's not a very good life. It's okay, maybe. It's okay. But what if I am 55 years old and I'm going to retire 10 years later? Well, at a rate of 3% inflation, 10 years later, in order to enjoy a 50,000 lifestyle, I would actually need to have 67,000 to enjoy the same lifestyle, which, by the way, is not very good. It's enough, but it's definitely not luxurious, right? What if I'm 45 years old and I'm going to retire in 20 years? 20 years later from today, to get a $50,000 lifestyle, I would actually need 90,000 by that time. Okay, and at 30 years, I will need, if I'm 35 years old right now, I would need $121,000. So now that inflation, what is the rate of inflation today in today's economic situation? It's over 7. Over 7. So think about it. Inflation is real, and we need to do something about it. We cannot just ignore and pretend that it doesn't exist and it's just a catchphrase, right? Excuse me. Sorry about that. All right. And if you have questions, you can type it in and I'll try to answer to them toward the end, okay? All right, so that's the number 4. And the last concern that we're going to be talking about is taxes, right? Everybody understands that, we have to save taxes. But this slide, I think everybody in Champion Team seen it already. But I want you guys to pay attention how each of us leader explain it, and you explain it in your own way, and I have my own way to explain it, right? So we know that the IRS allow us to invest in, pay taxes in 3 ways. One, the category is a tax yearly. And some vehicles are savings, CDs, right? We put money in the bank. At the end of the year, the bank will send us a interest statement if we have any, right? And we have to file that interest together with our income tax every single year. Stocks, same thing. Now, stocks, let's be careful though. That's assuming if I sold stock within the same year and I make money, then I have to pay taxes. Mutual fund is kind of similar. Okay, except the dividends, mutual fund, even if I don't sell, I might still have to pay taxes because of the dividends, right? Rental income, what do I have to pay taxes on? I had to pay tax on property tax. I had to pay tax on income that I receive, less expense, less depreciation. But nevertheless, all that income I had to pay. The rental is part of my total income, right? Now, the second category is a tax deferred bucket. The 401ks, the 403s, IRA, SEP IRA, pensions, annuities. And when I sell the house, if I have investment property, if I sell it, right, the capital gain, I also have to pay tax. And last category are we pay tax first, but all the gains are tax-free, right? And some examples are Roth IRAs, 529s, muni bonds, and our flagship solution, the IUL, the 7702, or the VUL for that matter. Now, when I explain this to clients or my friends, I always say this, right? I say, hey, it doesn't matter if we are the middle class or we are Bill Gates. The bottom line is that even if you're Bill Gates and very wealthy, or Elon Musk, you have the same set of tax rules. Okay, so in that regard, I think it's good that the IRS takes care of everybody the same. Okay, it doesn't matter if you're average or you are super wealthy, the tax laws are the same. So, which means that we being educated, we can do something about having a tax efficient retirement lifestyle. Okay. Now, so let's take a look at this tax risk. How does it impact us? So let's fast forward, assuming that, in some year, maybe 10 years from now, maybe 20 years from now, maybe 30. And at that time with inflation, let's say I need $150,000. We already see the $150,000 if I have 20, 30 years from now is really not that much money. But let's just say that I need $150,000 for my retirement annually. That's the lifestyle that I want, okay? Now, what if, and by the way, this is the tax bracket. By the way, this is an example. This may not necessarily be the very current tax table, okay? But it gives you enough concept for what I'm about to show everybody. So we all know that the tax bracket, and I'm using marry file jointly, by the way, which I think that the majority of us in this call are probably filing marry file jointly. So I'll use that. All right. So we know that we are taxed based on tax brackets, depend on how much income, right? So the lowest income, we pay 10%, that's up to $19,000. From $19,750 to $80,000, we have to pay 12% for federal tax. And then 22 and 24 and so on and so forth. So I do know that here are the lower tax brackets, here are the middle tax brackets, and here are the high tax brackets, right? Now, if I need 150,000, that's my wish. And let's assume that I am going to pull all my money from, let's say, 401k or a taxable account. So in order to net 150,000, which is my desire, I would actually have to pull $181,000. Why? Because I have to pay this 4 tax brackets, right? $181,000 falls up to this point actually. So I will have to pay some in 24%, some in 22, some in 12, and some in 10, correct? And the total amount of tax that I pay is $31,000. So by pulling 181,000 minus 31,000, I net the 100,000 that I desire. Okay, that's one way. What if I can choose a hybrid strategy? What do I mean by hybrid? I want to do in such a way that I only want to pay taxes based on the lower tax brackets because I know these two are lower, right? So I want to skip the higher tax bracket. Well, how do I do that? Well, from my 401k or the likes of 401k, I'm just going to draw 80,250. Why? Because that's the threshold of the tax limit for the low tax bracket of 12%, right? So I'm just going to pull up to $80,250. How much tax do I pay for 80,000? Well, I'm just going to pay the 12% and the 10, and that equates to $9,235. What about the upper or the middle tax brackets? Well, for that part of the income, I am going to draw from a Roth or an IUL account, $78,985. And how much tax do I pay here? Well, zero. So altogether, on this strategy, I actually I pull $158,000. Oh, I'm sorry, $159,000, and I pay only $9,000. So do you see, after paying the tax, I also have $100,000, like the strategy on the right-hand side. Both of them, I end up with 150,000, but on the left-hand side, I pull only 159,000, whereas on the left, I pay 180. Well, how much is the savings there? The savings between 31,000 and 9,000 is $22,000, right? Now, if I'm retired and if I were to live or want to consume money for 20 years, each year I save 22,000. In 20 years, I would have saved 451,000. That's a lot of money, isn't it? That's a lot of money. Now, I want to be clear though, that I actually did not save to 451,000. Why? Because the Roth and the IULs, I have paid the taxes in advance already. So I want to be sure that we understand and we don't confuse our client that I actually save this much taxes. However, I do want to caution everybody though, once you retire, having to cough up $22,000 in taxes is not a good feeling. So the bottom line is that we want to pay some taxes while we're still young and still working and still have income. Number one. Number two, what if future tax rate increase? That means that right now when tax rates are low, I might want to pay some taxes today so that in the future, I can be tax-free, at least for some of the strategy. Some part of my income should be tax-free, okay? So this is the tax impact that we need to understand and some ways that we can strategize. All right. A lot of people feel, it's so shocking that I talk to so many people, and I do not want to use the word ignorant to describe, but unfortunately, that is often the case with a lot of people. A lot of people think that 401k, we don't have to pay tax. A lot of people think that Social Security, we don't have to pay tax. A lot of people think that when we retire, we simply don't have to pay tax because we don't have income. And we all know in WFG Champions, we know that's simply not true, okay? So right here, I'm just going to clarify, actually Social Security income is very likely for most of us in this call, we probably going to pay tax on it. Well, let's take a look. Assuming we marry file jointly, and let's say that our retirement income falls between 32 to 40,000, 44,000. Everybody, do you think this is a lifestyle that we want? $44,000? I hope not. But let's just assume that my income at retirement is between 32 and 44, the taxable income. Well, guess what? Whatever I collect in Social Security, 50% of that is taxable. So let's say, for example, if I were to collect $2,000 per month, and my income at that time is 44,000, including, by the way, the Social Security, okay? Then that $2,000, I will have to pay at least 1,000 is taxable, 50%. Now, how many of us would like to have more than 44,000 in retirement income? Well, I hope everybody. So if we make more than 44,000, guess what? 85% of our Social Security is taxable. So in that example that I gave, if my Social Security is 2,000 per month, 85% of that, which is roughly $1,700, is taxable. So do not believe that Social Security is tax-free. Okay, so let's unless you live right here, then you can say it's tax-free. Okay, but that's not a good life to have for most people. All right, so let's cover some common type of retirement vehicles. Okay, and there's a lot of information. I want to go kind of quickly. The first category is the 401k. Okay, now I'm going to classify 401k, 403, 457. These are all similar. Okay, I'm just going to call them 401k. 401k are for private companies. 403 are for, like a nonprofit, maybe like a hospital, maybe like a university. 457 are oftentimes for like government employees, but their tax treatment are all the same, So I'm just going to call them, I'm going to put them together as one category. So the tax treatment or the characteristic rather for 401ks are advantages. First of all, well, they can be deducted for tax purposes for income, tax deductible, very good. Number two, they can be tax deferred, very good. Number three, a lot of companies provide match, very good. Number four, it forces us to save. If we participate in it every 2 weeks, the paycheck, they just deduct automatically. It's a great discipline to save, right? That's awesome. Next, dollar cost average. Every 2 weeks, I'm saving the equal amount of money, right? So that's good too. There's contribution flexibility. What if I, temporarily cannot contribute? Maybe I want to buy a car. Maybe I need to pay some medical bills. Maybe I want to help my parents. So I can stop contribution if I wanted to. So pretty flexible. I can contribute more. I can contribute less. So pretty flexible. Actually, the money that I saved out in the 401k account, I can take money out via loans. So that's kind of good with a little caveat, which I'll explain in a second. Now, some disadvantages. Number one, I had to pay all of it. Every penny for my 401k is taxable when I withdraw in the future at the tax rate in the future. So in the tax rate in the future, if it was higher, then I had to pay the higher tax rate. Okay, and the likelihood will be the case. Second, limited contribution. Why? Because in 2023, the highest contribution I can make to 401k is $22,000. Okay, now, if you are 50 years old or above, like myself, I'm 54 years old. If you are 50 or above, you can contribute 5,500 more. So we can contribute 27,000 or 28,000 per year. Okay. Now that may be good for a lot of people, maybe most of people in this call. However, if you make large amount of, if you have a good salary, then may not be that good. I will explain in a little bit. Now, if we were to draw money from our 401k prior to age 59 and a half, we will have a 10% tax penalty. The early distribution penalty imposed by the IRS. Plus, we have to pay the taxes. Okay. Now, it's subject to market risk, right? Because unless I put it in cash, most people don't do that. So the 401k, we can lose money in it if the market does badly. Limited investment choices, the limited investment choices, because usually in corporations, the number of mutual funds available are limited, usually maybe 20 to 30 funds to choose from. Okay. No lifetime income. If I live too long and I use all my money, well, sorry, I cannot use 401k to treat it as a pension that pays me for life. No lifetime income. Okay. And this is a kicker though. The flip side of can take out loans here on the left-hand side is that if I were to leave my job, maybe I find another job or I got laid off or I want to take a break, the loan, if I have borrowed money from my 401k, must be paid in 90 days. 90 days. I just so happen to have a colleague of mine. He's a member. I don't know if he's in the call today. He's about to change jobs, and in 90 days you have to pay the loan. If you don't pay the loan, 10% penalty and have to pay the taxes. Okay, so these are the pros and cons of 401k plans. Let's talk about the traditional IRA. These are accounts for people who do not have 401k. Okay, maybe certain companies do not offer employee benefits, right? Or maybe a stay-home person do not have a 401k because it's a stay-home mom or a stay-home dad, right? So the advantage for this is that just like very similar to 401k, tax deductible, tax defer, and this is usually good for lower income households, and I'll explain that in a second. Some disadvantages though. Number one, same thing, have to pay tax on every penny of the contribution plus gains in the future. Lower contribution limit, because the maximum that one can put is only $6,500. And if we are 50 years old or above, we can put $1,000 more, $7,500 altogether. There is no matching, obviously, because it's not an employer's plan. So, think about it. If you want to save $6,000, $7,000 per year, sure, that's a great start. But if you're high income, and you only want to save $7,000, it's not a lot, right? It's not enough to save for the retirement goals that we want to reach, right? 10% penalty, same as 401k. If we were to withdraw early before age 59, we get 10%. Now, this is important. Low income threshold. And that means that it will phase out if our income goes too high. This is 2022 and this is 2023. So if we are married and file jointly and we make above $136,000, we can no longer, the household income, by the way, then we cannot contribute to traditional IRA. Let me give everybody an example. Maybe dad works for a company and makes $150,000, and mom is a stay-home homemaker. Well, the combined income is $150,000 from dad, right? Well, guess what? If mom wants to open a traditional IRA, well, no. Why? Because dad's income is above the threshold. Okay. Now, if you are single, that's even worse. If you make above $73,000 or actually $83,000, you can no longer contribute to a traditional IRA. Excuse me. Okay. Now, again, the investment are subject to market risk, just like the 401k. And just like 401k, if we live too long, we ran out of money. Well, sorry, no lifetime income. Next, the Roth IRA. The Roth IRA, our advantages are what? Well, tax defer. We don't have to pay taxes. And also tax-free on distribution. That's awesome. We don't have to pay taxes when we distribute. Wider investment choice than 401ks. And we can balance that tax burden at retirement, right? Because we don't have to pay taxes on the gain on the distribution. So we diversify our tax strategies. I have some 401k and I have some IRAs and I have some Roth IRA, so that I diversify my tax liability when I retire. No RMD requirement. This is a required minimum distribution, right? So 401k, we are forced to take RMD at age 72 currently, okay? So if you are affluent and you make too much money and you don't need the 401k money, well, guess what? You can delay it, but not past 72 years old. Now, some disadvantages of Roth. No, it's not tax deductible, so we cannot write off the contribution from our paycheck. It's also got pretty low contribution limits, same as the traditional IRA, $6,500 and $1,000 for people 50 years old or above. Phase out for high income earners also, okay? It's a little bit better than traditional IRA, but in 2023, if your household income about $228,000, cannot contribute anymore. So think about it. We have a lot of people in champion team, maybe Wudaf, maybe Jim Yu, maybe a lot of people that make above, maybe myself, we make above $250,000. Well, guess what? Our spouse cannot contribute to traditional Roth IRA because we make too much income. And if you're single, that threshold is 153,000. Okay, subject to market risk. The gains cannot be accessed before age 59, even though that they are tax-free, but we still have to wait until 59 and a half. The principal, I may be able to access, if I invested over 5 years, within it for 5 years, okay? No lifetime income, obviously. All right, the next category, the Social Security. Well, let's take a look at the advantages and disadvantages. Advantage is government benefit. Everybody who has 40 credits, the majority of us who work, for 10 years in America, we're going to have some kind of Social Security benefits. Lifetime, this is awesome, right? They pay us for life. And we can provide benefit to our spouse. If I were to pass away, my benefits, my spouse can continue to take on my benefits. Some disadvantages is double taxation. You ever thought about that? Double taxation. What does that mean? If you work for somebody and you can take a look at tomorrow or when you get paid, your check stub. Your check stub is going to have the FICA tax, and that is the tax that goes to Social Security, right? So if you make, I don't know, $50,000, the FICA tax, whatever they charge you, goes is the tax that you pay for Social Security when you retire. However, when you retire and your income is above 44,000, you get taxed again. That's why it's called double taxation. Okay, that's not very good. Limited benefit amount. We know that it is a safety net, but it's definitely not enough for the lifestyle that we want to have. The maximum for Social Security today is about $3,500 per month, 35 to 36 at the full retirement age. Okay, no growth potential. Whatever I get is what I get. Sometimes we may get a cost of living adjustment. Okay, so don't think that we are getting a pay raise. We are getting a paycheck increase because of the inflation. So cost of living adjustment. The government determines that. Some years we have more, some years we have less. Like last year we had a good COLA. This year we probably won't have a good COLA. Okay. Now, no death benefit, right? Only spousal support benefit. But if I'm married, that's great. But what if I am single, right? Then if I pass away, then no death benefit provided to my heirs. And right now, because of the Social Security, it is such a big burden for the government. So the government either needs to raise taxes or extend the full retirement age. Either reduce benefits or extend the full retirement age currently at 67. So, if they extend it, maybe by the time I'm 70, then I can barely collect, and that's not good. Talk about pensions, advantages, tax deferred, lifetime income, that's great. Employer pays it, that's even better. Some disadvantages are, well, they are taxable for sure, every penny of it. Second of all, it's a disappearing benefit for most of us. How many people has a pension? Feel free to type in chat. You probably type it proudly, but the majority probably do not have pensions. You had to work for the government or for maybe some private company may, but very, very few. So the reality is that most of us cannot count on pension. Typically lacks lump sum access. That means that whatever they pay me, I cannot say, well, I want a lump sum. Some company allows it, some company do, but not all. Okay, a lot of time it's just a monthly or yearly benefit until I pass away. Low growth potential, no COLA, usually no COLA. Definitely no investment choices because the government runs the program. So the account is the government that pays us. So no control over the investment choice. And for most part, you have to be long vested period. What does that mean? If I were to work for the post office and I only work there for 2 years and I retire or I quit, I probably won't have a pension. Usually typical government entities, they will require someone to be working there for about 20 years to receive the full pension amount. That's called the vesting schedule. Okay, so if I don't work long enough, I either may not qualify or I may not qualify for the full amount. Subject to change. So don't think that if you do have pension today, that you are in the driver's seat. Why? Because companies can very well change that. If you don't believe me, you can check out, for example, the city of Detroit, the city of Vallejo in California, American Airlines, Ford Motors, Ford, I think it did, United Airlines, every major airline, they had reported bankruptcy. Why? Because they want to get rid of, they want to reform pensions. So do not believe that because today you have pension, that it is secure 20, 30 years from now or 10 years from now. It may be subject to change, okay? And you cannot walk away to the next job, okay? And a lot of time, companies get acquired, and the new company may not offer that plan, and they may provide a payout, and that's it, okay? So pension, that's that. Now, another category, we got two more categories to go, is the annuity. The concept of annuities have advantages, I think a lot of us understand. Number one is tax deferred. Number two, there's no contribution limit. Remember that 401k has a contribution limit of how much? $20,500 this year. The traditional IRA has a contribution limit of how much? $6,500, right? Et cetera, et cetera. Annuities has no contribution limit. You want to throw in $1 million? Go ahead. Okay. In fact, it actually has a lower contribution. You know, if you want to do like $5,000 annuity, don't do it. Don't waste your time. Right. So it does require an amount that is interesting enough to make a difference. Okay. Now, guaranteed lifetime income. That's great. Pays us for life. Potential death benefit. Some annuity have that feature. No market risk. That is one of the biggest benefits for annuities, that we do not lose money. Has growth potential. Okay, especially nowadays, annuities are becoming so popular. Wide range of fee structures. A lot of time in the old days, you know, and I'm talking about the old day, maybe 5 years, 10 years ago, people would badmouth annuities. Why? They would say, well, you know, they have fees. Fees are expensive. The solution is complex. Well, guess what? If you understand it, it's not complex. And when it comes to fees, some annuity, a lot of them actually today don't even carry fees. That's what a long way annuity has come. Okay, wide range of product features. A lot of annuities right now, and these are some of the features. You know, maybe a buffer protection, return of premium, income doubler for long-term care, inflation safety net, wide range of investment choices. There's just a lot of features today in today's annuity. Some disadvantages though. Well, guess what? It's taxable when we distribute, okay? When we start taking income. Second, some limitation on liquidity. Why? Because annuities are designed to pay us for life. So I cannot walk away with the lump sum. It's just like my 401k. I cannot tell the government, well, you know, give me more this year, so tomorrow, next year, you don't have to pay me anymore. Well, you cannot do that. So there are some limitations. We have to follow a certain schedule defined by the annuity company on how much they pay us for life. It's not as flexible as a 401k per se. Surrender charges if we cancel too early. So if I have an annuity, typically maybe 7 years to 10 years, if I were to cancel the contract, then I may suffer a penalty for cancellation. Now, keep in mind, cancellation, surrendering is not the same thing as taking income. I'll explain. Let's say that if I am 59, or let's say I'm 60 years old. If I were to do an annuity, I can pay income. My income can start immediately, like next month, right? Even though that the surrender schedule is 10 years. What does that mean? I can take income as long as I'm above 59 years old, 59 and a half. So that doesn't mean that I cannot touch the money for 10 years. Okay. Now, it simply means that if I surrender, if I cancel the contract within 10 years or 7 years in many cases, then I may suffer a penalty. Okay. Now, of course, there are some plans that do require us to wait a little time, maybe 7 years, maybe 10 years, maybe 1 year, okay? But surrender schedule doesn't mean that I have to wait it out before I take income. Some products have fees, okay? And some do not have fees. The last category I want to talk about is the IGIP, the investment grade insurance plans. Advantages, tax deferred, tax-free via policy loans, right? So all the money built up is tax-free. Tax-free death benefit, okay? Remember, because it's an insurance, so if God forbid something happened to me, I pass away, my family, my loved ones will receive the entire death benefit income tax-free. Remember the contribution limits for the other plans? Only annuities and insurance do not have limits, okay? I can design it in such a way that I can put in the amount of money that is suitable for me. If I'm a medical doctor, I make a very good income, then I can design a plan that I can allow me to put more money into it, right? No market risk, that is for the IUL. Highly leveraged death benefit. Think about it. If I were to open an IGIP, let's say an IUL, and I bought, I signed up for one $500,000. And let's say my premium was $500, right? And I'm contributing $500 for like 2 months, and God forbid I get run over by a truck and I pass away. I ran over by a car accident, pass away. Well, my family receives what? $500,000. How much money did I pay? Only $500,000. Only $500 twice for 2 months. So that is called high leverage death benefit in earlier years. We can access the money before 59, right? If I have some money emergency funds, I can utilize it. Reasonable return, much better than interest in the banks. We can add long-term care. And for those who have school children going to college, the money saved inside life insurance does not impact financial aid. Some disadvantages though, not suitable for short-term investing. So maybe I'll give everybody an example. Let's say if I just sold a house because I sold it for a profit and I have some income, but I plan to buy another house in about 2 years. For these 2 years that I'm waiting to get back in, if I were to open one of these IGIP or IULs and I cancel it 2 years later, that's a no-no. That would not be a smart thing to do. Why? Because the IGIP is designed for long-term, not short-term. Surrender charge if we get canceled too early. Just like anything good, we must have good discipline, okay? Contributing every single month, put it in our calendar or in our auto pay. Requires underwriting. So we have to have reasonable good health. If we're not too healthy, then even if we want it, we may still not get it. Proper funding is the key. We want to fund the plan accordingly, not always paying the minimum. I know everybody likes to pay the minimum, right? But guess what? If you put only the minimum, then that means that we are not taking advantage of everything on the left-hand side, because I'm basically just paying the minimum and there is not too much surplus for me to enjoy the growth and the tax-free access. Now, let's talk about, those are the several things, and I promise you guys that I have a lot to cover today, right? So, we talk about 401k, IRA, Roth IRA, annuities, pension, Social Security, IGIPs, right? Now, let's talk about strategies. Well, let's go ahead and optimize it with an IUL. So let's say that my 401k, okay, and I'm using 401k, could be my 457, 403. And let's say that if I have worked many, many years and I have a sizable $1 million 401k, okay? And I am now going to retire and I would like to draw 6.5% from the million every year, $65,000. The remaining amount of money, I'm going to leave it in the account to continue be invested. This is my 401k. Now, this is the actual rate of return for the S&P 500. And these are the actual 5 years that the market returned negative. All right, so if I have $1 million, I'm taking $65,000 every year, and the remaining amount of money, I leave it to grow. Some years it grew, some year it lost money. Guess what? 20 years later, my $1 million is almost gone, pretty much gone. Well, what if I make a optimization strategy with an IUL? Okay, well, same thing. I got my $1 million, I'm taking 6.5%. And the remaining money continues to get invested. But guess what? At the end of each year, I would know already how the market did for the year. If it did negative, any negative years, I simply don't draw money from the 401k. I don't draw my 65,000. Well, guess what? 20 years later, I pretty much preserve my initial principal of $1 million. Now, what am I going to do for those 5 years that I did not take any income? Well, guess what? If I had designed an IUL plan from early and I saved up some money, in my example, I saved up, let's say, 285,000. I saved that over the years, right? Now I am retired. I am going to supplement from this cash value the amount that is needed, $52,000, to spend the years that I did not take money from the 401k. Why 52,000? Because it's tax-free. Remember, 65,000 is taxable. So 65,000 is probably equivalent to about 52,000 that is tax-free. Okay. Now, guess what happened after 20 years? My IUL account, it started for 285,000, actually grew to be almost $500,000. And that is took 5 years of $52,000. So what about the IUL? Remember that is an insurance, right? So it pays me a death benefit that I call it a bonus. So God forbid, any given year in this 20 years, if I were to pass away, my beneficiary would receive the death benefit. So to summarize right here, number one, my 401k is preserved. Number two, I use a hybrid strategy to take money from the IUL on the negative years, and the remaining continues to stay invested. I don't run out of money either. Actually, I grew, and I also have a death benefit as a bonus. God forbid something were to happen to me. Let's talk about, I'm running out of time. I got to go a little bit quicker. The annuity concept. I think everybody already understands this, right? So, we have another talks about annuity. I don't go too much into depth. Annuity, we know that our money never lose money if I were to use index annuities, right? Say if I have $100,000, the market always grows or stays flat, never loses money. On top of this, I would also have a so-called a protected income base, right? So you see, this is my contract value. This is my protected value. Now I am going to retire at 65. I can walk away lump sum, taking away this money, or I can take away a pension value times a percentage. How much is the percentage? Usually about 5%, depending on the age. Okay. So remember, everybody, I had that strategy talking about the market rate risk, 4%. 4% is the recommended. Well, right here I can take out 5%, right? Even in some cases, even more, 5% higher. So I can take money for as long as I live. Even if I ran out of money, I can still take income because it's an annuity. It pays me for as long as I live. That's the concept of annuity. Okay. Now I want to put it all together now to use a 50-50 strategy. So on the left-hand side, I'm going to say that, first of all, let's assume that I have $1 million. I'm 60 years old, and I plan to retire in 5 years at 65. So what I try to do is that I'm hoping that my $1 million can grow a little bit more in these 5 years. My strategy number one is having the $1 million in my 401k, my mutual fund, or stocks. Okay, that is strategy number one. If I get lucky, the market did well. Maybe the market did very well, grew 50% in 5 years. So my million went to 1.5 million. Remember that withdrawal rate risk of 4%? I'm just going to use that. So assuming out of the 1.5 million, I'm going to take 4%. That is $60,000 per year for my retirement. Not too bad, right? But what if I'm not that lucky? What if I encounter the 5 years of market downturn and my $1 million actually dropped by 30%? Well, now I have million minus 30%. I only have 700,000. I'm still taking my 4% as recommended. Now 4% of 700 is only 28,000. Do you see a 60,000 lifestyle versus a $28,000 lifestyle? Is very different. Now, what if we were to apply a 50-50 strategy? Okay, so same thing. I am going to split my $1 million, but now I'm going to split it into 2 accounts. One, my stocks or mutual funds. The other one, my VA, variable annuities, or fixed index annuity for that matter. They do the same thing. Same thing, good year, market increased by 50%. So my 500,000 increased by 50%, got to $750,000. Good year. I'm going to take my 4%, that equals 30,000. The other $500,000 in the annuity, also good year, of course. So it increased also by 50%, also 750. But remember that I can draw at a higher rate, in this example, 5%, right? That equals to 37,500. Add it together. Oops, sorry. Add it together. Oops, I'm trying to get back. How do I get previous? Okay, previous. There we go. All right. Add it together. I got 30,000 from my stock account and 37,000 from my annuity account. Altogether, 67,000. Good year. Better than the 60,000. What about if I wasn't lucky and the market dropped actually 30%? 500,000 less 30% is 350. I'm taking 4% of that, $14,000. But what about the annuity? We all remember annuity never loses money, right? So even though in market down years, my annuity still increased by 5%. In my example, by the way, my example, 6%. I'm using an annuity that pays minimum 6%, even if the market risk drop. So I got every single year, my annuity grows by minimum 6%. And since I have 5 years, I'm going to multiply by 5. Well, guess what? When it's time to claim money 5 years later, market downturn, my account did not lose, actually grew to be 650. I take a higher payout rate of 5%, right? 32,005. So in bad years, what do I get? 14,000 plus 32,000 equals 46,000. Much better than the 28,000. You guys agree? So no matter in good years or in bad year, by doing a 50-50 split, I end up more advantageous. Okay? Good year, I get paid 7,500 more. In bad year is my biggest concern. I actually get 18,500 more. All right. I had to cut this short. Otherwise, I'm already against time. So I think everybody saw this. I'm just going to, I had to skip this page. Okay. So this is really just reallocating. I think a lot of people probably saw this. Is really just lowering the exposure in real estate, 401k, in risky investments, and then change it to something that looks more like this. Shifting some money into guaranteed solutions such as annuities or such as IULs that also have tax-free features. So to close it out, how do we optimize it by diversifying? Well, I'm not promoting just annuities or IUL. I certainly like 401k because it has benefits. 401ks, the benefits are the match, the tax deferral, and it's very liquid after 59. But I have to bear the market risk. Running out of money is an issue, and I have to pay the taxes in the future. How do I compensate that? Well, I can have some real estate. It will increase my cash flow because I can collect rent. The real estate over time usually appreciate. That's great. But real estate lacks liquidity. And I can compensate with the 401k's liquid features. And then what happens if my tenant does not pay rent? Legal risk. If I'm going to add an IUL, I can combine and take advantage of don't have to pay tax, never lose money, no market risk, But the short-term investing, I can either do stocks or mutual fund. I wouldn't do real estate for short-term either. I had to be in good health, and I had to have a good discipline about saving. And last but not least is the annuities. Annuities covers the lifetime income. What if I live too long? Never lose money, and if it's cash, it's tax deferred. But it does not resolve the liquidity issue or the surrender issue that I can address it with the other solutions. So all in all, there is not one single magic solution, but if I were to put different solutions together, I can enjoy a magical outcome, and that's called optimization. Guys, that's all I got. I went over 2 minutes. Actually, I went 1 hour because we started 6:02. Thanks, everybody. Those people who needs to drop off, by all means. And those people who want to stay around for a few questions, I'll answer for about 10 minutes. So let's take a look. What questions do I have? Let me see what I got here. A lot of questions. Let me see. Let's see. Too many high. Okay, I appreciate that. Okay, that's okay. Yeah, Daniel Kim. Yes, Social Security is tax. It's not new information. It's been there a lot, but I'm glad that you pick it up today. All right, George Smith, office pension. Okay, vested after 6, but not full amount. Correct? I do not know. You have to check with the post office. I believe so. My aunt works for the post office, but she worked there for 6-7 years. And the vested is so small. It's like 20% of the total amount. So small, okay? So even if, so you better double check. But nevertheless, it's very, very small. Roll my out when I left for that reason. Erica Ellington, I think that's a comment. All right, thank you. Yang Shaorong, I think. What if the insurance company goes bankrupt? Okay, very good question. What if the insurance company goes bankrupt? That same question, what if the 401k plan goes bankrupt? Or that same question, what if your bank, maybe Chase, maybe Wells Fargo, whichever your bank, goes bankrupt? The point I want to say is that in America, everything is protected for the consumer. The banking has the FDIC. The securities investment has the FDIC. And the insurance and annuity has the Guarantee Association. Okay. Now, I check, if you can Google it, and you can see how many banks went bankruptcy over the history and how many insurance companies went bankruptcy. And I can guarantee you that there is a lot more banks that went bankruptcy than insurance companies. Okay. So the point I'm saying is that they are protections. Obviously, there are some fine details about limits. Okay. But nevertheless, if you want to be safe, you want to stay with good insurance companies, rated A or above, okay, in my opinion. All right, so that was the question. If the insurance company went bankruptcy, would you be able to collect my distribution? Usually, you know, when an annuity company goes insolvent, usually it's because they are unable to pay, right? So the customer base is still there. So more often than not, almost always, they will be taken over by a larger company. Why do they want to do that? Because the larger company can take over all the benefits from that existing clientele. Okay, so do not think that usually larger company would acquire the smaller company that is going insolvent. Next question: can you move back to life insurance slide slide? Okay, I'll get back to that. I don't know what slide you're talking about. I'll get that in a minute. Screen share is not loading. Oh, I'm so sorry. There, it's a bit lagging. Oh, I'm sorry. We're done. The slide's very good. Is it possible to share? I will not be able to email to you, Mohan, but feel free to ask your SMD, and he or she will give you the best solution. Okay. Later, would you please show annuities, insurance pros and cons screen? Yes, I will. Give me a moment. Warren was right. The split investment don't put all eggs in one basket. Okay. Yes, Lena. Please share the PPT to me. Okay. Yeah, ask your SMD. You're welcome. Thank you. You're welcome. Amazing knowledge. I appreciate that. Thank you, everybody. Let's see. great delivery information on complex subject. Okay, thank you. All right. Roth slides 再放一下. Okay, I will. Excellent percent. Thank you. President with lump sum often comes with loose of the other benefits. Yeah, and that's a good thing, the Sharon Guo. That is a great question. I actually done a few pension as a lump sum. You will lose the benefit, okay, other benefit. However, what you want to do is that you simply compare the pension amount. So let's say you are in company A that pays you a pension. And company A, the pension allows you to do a lump sum option. Then you calculate, if I were to roll it into a company B, such as an annuity, what is my benefit? If my benefit is better than company A, then I can certainly, if it's permissible, roll it out. That is a good thing. All right, correct. I'm 29. I am at 29 post office. All right, George Smith. All right, good for you. You are a baby in a post office standard. I know that anybody that works less than 30 years are babies. Just kidding, but great career there. How does it mean we should enroll in So does it mean we should still enroll in 401k? Okay, 401k, great question. Yes, you want to enroll in 401k. So I don't want to say that it's no good, but I want to say that you want to diversify. And for the general concept, you definitely want to get the match. You want to enroll, you want to participate, you want to get whatever income you need to contribute to get the match. Okay, so usually I'll give you an example. Let's say you make $100,000. Company would usually match, I don't know, 6%. That means that 6% of $100,000 is $6,000. So for your $6,000, they will match it. So you have to contribute in order to get the match, the 6,000. But any dollar above 6,000, you may not necessarily want to match, contribute. Why? Because you might want to check your company if it has a Roth 401k. If they do, you might want to contribute to a Roth to balance your strategies. So the what is it? The annuity and the insurance. Is this a slide that you want? Go ahead and take the screenshot. I'm sure that that's what you want to do. And then is that good? All right. Second, somebody asked about the annuities. There it is. Take your screenshot. Anybody else? Let me see, what other question do I have? Is 65 too old for considered IUL? Well, depends. Because at 65, maybe your goal, this is for Li Zhang, Zhang Li, 是吧? Zhang Li. 65, depends. Maybe at 65, your goal or your client's goal is not to use insurance for cash accumulation, right? Because maybe they don't have enough years. However, for long-term care, it's definitely not too old. Definitely not too old. What about death benefit? What about utilizing insurance to pay for estate taxes? Definitely not too old. Okay. So is 65 too old? Short answer, no. Is 35 too young? Well, depends. What happened is that 35-year-old person is not very healthy. Okay. So it's never too old. It's just based on the situation. Annuities are tax-free, Pratibha. Annuities are tax-free. Answer is no in most cases, okay? Unless your annuity is a Roth annuity. If it's a Roth, then it's a tax-free, right? So annuity does not change the tax code, okay? If you have a cash annuity, let's say you have some cash in the bank and you put it in annuity. Let's say you threw $100,000 cash. That portion, the $100,000 is your principal, is your cost basis, no tax on that. The gain will be taxed. So the annuity is taxable based on what it was before. If it's coming from 401k, all of it is taxable. If it's coming from Roth, all of it is tax-free. If it's coming from cash, the cash is tax-free, the gains are taxable. Do you recommend IUL? What? Do you recommend IUL or your people age 2? I don't know. I guess this anonymous. Do you recommend IUL for people who is age 2? I'm guessing. Yes, definitely. For children, IUL is a great product, and I'll tell you why. Think about this. They have at least 50 to 60 years of compounding. You agree? Can you imagine any vehicle, stocks, well, they cannot have 401k, you know. If any vehicle you compound it for 50, 60 years and it is taxable at the end, can you imagine that? And the IUL is tax-free. So generally speaking, for kids, yes, good. And I always say general speaking because it always depends on the situation. Is annuity including assets? I don't understand that question for Makunda. I don't understand. I guess you're asking for college financial aid, I take. Is annuity including asset? A qualified annuity is not. A non-qualified annuity is. What does that mean? If it's the annuity is coming from a rollover, like a 401k, IRA, then it is not considered assets for financial aid. However, if you are investing with cash, that part it is included as asset for the FOBSA, if that's what you're asking. You can still contribute to traditional IRA, but not get any tax benefit. No restrictions on contribution. Neelam, let me see. You can still contribute to traditional IRA, but no tax benefit. Well, I think, Neelam, you are probably 99% right, or you're not wrong. You're not wrong. But I think that you want to, there is a limit, I believe is $57,000. You can contribute up to $57,000. You cannot do the tax deductible beyond the 6,500. But yes, you are right. You can contribute, but there is a limit. There is a limit. So for this, be careful with this. You check your tax table. Can one have 401k and IRA at the same time? I don't think so. However, you can have 401k and your wife or the other way around, the stay-home parent can have an IRA. I think I'm almost right. And those who, if I'm wrong, please correct me. But I'm almost right. I think so. All right, guys. I believe I answered all questions. It took me about 11 minutes. All right. Anything else? Let me see. All right. You're welcome, guys. Let me see. Q&A. There's a few more, including asset. All right. I think I answered all the questions. All right, guys. You know that we went over a little time. I want to thank everybody. I hope that it was a good information for you. And I look forward to having you guys online next week for the next topic, which I don't know what it is, but I'm sure it's going to be great. Thanks, guys. You guys enjoy your Monday evening, and I will see you next time. Take care, guys. Good night.